Hi guys, it's Stock Curry, and two of the 40 largest banks have collapsed in the last 3 days, yet stock market futures are up 1%, pointing to a massive rally on Monday. I'm going to explain why and tell you everything that's going on, so let's get into it. A ton of news has come out over the past few days, including a deluge of news on Sunday evening alone. I'm going to go over all the news, explain everything to you, but in order to understand just what is happening right now, we have to go back to 2008 and get a little bit of a history lesson so that you can understand what's happening today. On March 14th, 2008, ironically, the exact same weekend as right now, stocks tumbled on Friday over scares of a Bear Stearns collapse. News came out that Bear Stearns needed emergency funding due to a liquidity crisis. On that Friday, bond prices surged, causing yields to drop. That's because investors loaded up on bonds as they pulled their money out of the stock market. Remember that because the same thing happened on Friday this year as well. In addition, the Dow Jones Industrial Average fell 1.6%, the S&P fell 2.1%, and the Nasdaq fell 2.3%. Bear Stearns stock, on the other hand, fell 47%. This followed news from just a few days earlier where Bear Stearns denied that they were suffering a liquidity crisis. Now, if all of that sounds familiar to what happened on Friday, it's because it is. It was essentially 100% identical to the exact same thing that happened to Bear Stearns on the exact same weekend 15 years ago in 2008. Then on Sunday, a lot of news came out, and by Monday, March 17th, 2008, stocks were down, but they were kind of off their lows. The Dow Jones Industrial Average had lost 0.9%, the Nasdaq was down 1.6%, and the S&P was down 1.5%. Meanwhile, Bear Stearns fell 87%, while JP Chase, who ended up buying Bear Stearns, their stock rose by 8% as people felt like JP Chase was secure financially and they didn't have to worry about Chase going out of business. At the same time that JP Chase bought Bear Stearns in order to avoid a collapse and spread further fears about the world's financial markets falling apart, fear started arising that Lehman Brothers might be next. Shares of Lehman Brothers fell 15% on that Monday, while the firm made a statement saying that they had plenty of cash to keep doing business. Meanwhile, the Federal Reserve also took bold action that Sunday in order to provide cash to financially squeezed Wall Street investment houses in an effort to stop the credit crisis from spreading throughout the U.S. economy. Now, in a minute, when I get to all of the news that occurred on Sunday, you're going to find that this sounds identical to what happened to Bear Stearns, and there is another Lehman Brothers, which we'll talk about here in a minute. And you're going to find that what happened 15 years ago is almost identical to what happened today, with a little bit of an exception. The stock market futures for Monday are not pointing to a red day. In fact, they're green, pointing to the market possibly opening up as much as 1% or more. I'm going to explain why that is in just a minute, but first, let's finish with our historical understanding of what happened in 2008. Exactly 6 months after Bear Stearns collapsed on September 21st, 2008, the stock market got pummeled. The Dow lost 4.4%, the S&P fell 4.7%, and the Nasdaq was down 3.6%. At that time, there had just been a government bailout of Fannie Mae and Freddie Mac, and fear was rising over Washington Mutual after the S&P cut their credit rating. At the same time, Lehman Brothers had just filed for bankruptcy. Lehman shares dropped 94% on that day. Now, what made that day in September so different from March is that unlike with Bear Stearns back in March of 2008, the government was not willing to help finance a takeover, bailout, or restructuring of Lehman Brothers. They just let them collapse. So what you have to understand from history is that so long as the government steps in and provides either a takeover, a bailout, or some sort of restructuring in order to help one of these companies that's going bankrupt survive, if that happens, the stock market's fine. It might drop a little bit, but it usually recovers. But if a bank collapses and the government does not step in to bail them out, that's when we see a massive crash in the stock market. So now let's get to 2023 and talk about what's happening with Silicon Valley Bank and whether or not the government or some magical buyer is going to come in and either take them over or bail them out. Now, before I get to all the news that came out Sunday night to kind of explain what's happening right now, I want to take a quick look back at Friday and really all the way back to Wednesday to understand how the bank collapse of Silicon Valley Bank actually went down, because this was the second biggest bank collapse in U.S. history. Now, a ton of people have already come out and explained exactly what happened. I'm just going to give you a very, very short narrative. Essentially, as a lot of money got deposited into SVB Bank over the past few years, they had to then go and buy some mortgage-backed securities as well as U.S. Treasuries, and it makes some profits off of those. So essentially, SVB would go and they would get maybe 1 or 1.25% interest from these mortgage-backed securities and these treasuries, and then they would pay maybe 0.25% interest to the people who deposited money at the bank, and then that extra 1 or 1.25%, they would just hold that, and that would be their profit. Now, all of that's fine. There's no issues with that at all, so long as people don't pull their money out of the bank. Now, if people start pulling money out of the bank, then the bank has to go and they have to sell those mortgage-backed securities and sell those treasuries in order to pay back the money that the customers are withdrawing. And all of that's fine as well, so long as they're able to sell those securities for close to the same price that they originally had bought them for. Where the problem lies, though, is when the Federal Reserve does massive interest rate hikes. When the Federal Reserve starts raising rates, their little 1% bonds suddenly are worth a whole lot less. And that's because if I'm a brand new buyer of a bond, and I know that I can go and I can buy a bond for 4% from the government, and then Silicon Valley Bank is over here offering me their 1% bond. Well, I don't want to get 1% interest when I can just go to the government and get 4% interest. So in order for Silicon Valley Bank to entice me to buy their bond, they have to lower the price. So maybe they paid $1 for that bond, but in order for me to buy it, I might only be willing to pay maybe 75 or 80 cents for that bond, since it pays a much lower interest rate than what I could get by going directly to the government. And that's exactly what happened. As people started pulling money out of Silicon Valley Bank, they were forced to go out into the open market and sell these bonds that they had bought years earlier. Problem is, they'd bought the bonds for around $1 and they were selling them for around 75 to 80 cents, meaning they were losing a ton of money. By Wednesday, the bank had already lost $1.8 billion, and they were seeking $2.5 billion in loans in order to shore up their balance sheets. Unfortunately, they were unable to find a loan. They then tried to go find a buyer for the bank. When that failed, by Friday morning, the FDIC went in and shut them down. Now, what's important to understand here is that in the news, in the media, you're going to hear that this was a one-off. This was a unique situation. This was a hysteria-induced bank run caused by venture capitalists. This is not going to spread to other banks. It's a one-off and every other bank is fine. Now, that's the narrative you're going to hear. And the reason you have to hear that narrative is that the government doesn't want people getting fearful that other banks might be in trouble. So the government's going to come out, they're going to say anything they can, they're going to do anything they can in order to quell the fears so that we don't end up with another 2008. But as we all know from the Bear Stearns fiasco, everything is not fine with all of the other banks. From 2008 to 2014, more than 500 banks failed. the largest of which was Washington Mutual, which everybody had fears about around the same time that Lehman Brothers collapsed. And if you look far on the right, you can see that Silicon Valley Bank was pretty close in assets and deposits compared to Washington Mutual when they went under. This is a major, major collapse of a bank. And what ultimately caused this was a massive bank run where people got fearful that the company was running out of money. They didn't have enough assets to match all of the deposits. People went and withdrew their money, and in no time, $42 billion of withdrawals were attempted, and this completely crashed the bank as they had to go sell those mortgage-backed securities and treasuries at huge discounts. The real problem is that the book value of an asset is very different from its market value. On the balance sheet, the book value shows how much that treasury or that mortgage-backed security is worth if it were held till maturity. But the market value is what you have to watch out for, because if there's a bank run and a bank has to sell off all of those bonds and all of those mortgage-backed securities and those treasuries, then they have to sell them at the market value, not the book value. And that's where we end up with these major losses, even if the balance sheet appears to be solid. And as you're going to see in a minute, the problems at Silicon Valley Bank were not limited to Silicon Valley Bank, no matter how much regulators and officials try to tell you that. Now, Friday morning, after Silicon Valley Bank failed to find a buyer and the bank run outpaced their ability to sell their assets, the bank ultimately got shut down by regulators in the biggest bank failure since the global financial crisis. And the FDIC said that insured deposits would have access to their deposits no later than Monday morning. Now, the problem with the FDIC is that they only insure up to $250,000. And at SVB, 97% of the deposits were above $250,000. And this caused mass fear and mass panic, because what happens to the 97% of deposits that aren't insured? Are those people going to be able to get their money? Well, as of Friday, nobody really knew. After the market closed on Friday, companies started filing forms with the SEC saying that they had cash at Silicon Valley Bank. Roku alone said they had 26% of the cash reserves stuck at SVB. And a massive number of startups and other companies were scrambling, trying to figure out how they were going to pay their bills and meet their payroll after SVB's collapse. Fears then spread on Saturday and Sunday about this being a possible Lehman moment. Trading in First Republic Bank, Signature Bank, and others on Friday collapsed, and those shares sold off, as well as other regional banks after SVB collapsed. Now, ultimately, whether the SVB collapse is a Lehman Brothers moment or a Bear Stearns moment entirely depends upon what the Federal Reserve does. Because if the Federal Reserve bails out SVB, that is, they somehow bail out their depositors, they shore up their balance sheet, they find a buyer, if there's some sort of bailout for SVB, then it's a Bear Stearns moment where we had a bank collapse, but people think it's limited, the stock market recovers, and at least for now, everything's fine. But if the Federal Reserve does not bail out SVB, then we end up with the Lehman Brothers moment where the concern is, wait a second, they're not getting bailed out. Now we have major problems in the economy. Now, in order for the Federal Reserve to bail them out, they're going to have to print money if they can't find a buyer. And the Federal Reserve, in order to pay back depositors, they've got to come up with about 20 or somewhere between 20 and $50 billion in order to pay back all of these depositors. And if the Federal Reserve chooses to do that and bail them out, then what we end up with is essentially quantitative easing or more money printing. And we all know that leads to higher inflation. So the Fed is really at a tough spot. Do they bail out the banks and stop a major recession and allow inflation to skyrocket? Or do they focus on inflation and focus on getting that down and let the bank collapse? Either way, they're kind of screwed because they're either going to allow inflation to skyrocket, which is going to cause more problems down the line, or they're going to allow the bank to collapse, which is going to cause more problems right now. Well, after Silvergate and Silicon Valley Bank collapsed last week, fears started arising on Friday about who would be next. And CryptoBank Signature slid on Friday amid troubles at Silicon Valley Bank, thinking that they might be the Lehman Brothers if Silicon Valley Bank was the Bear Stearns. In addition, First Republic and other regional banks also fell on the Silicon Valley Bank failure. Remember that in March of 2008, when Bear Stearns collapsed, Lehman Brothers stock fell 15% on fears that they would be next. But they weren't next. In fact, they managed to hold out for another 6 months before their eventual demise. So the question that I started having on Saturday was, if a bank run is going to cause these banks to collapse, we don't have to wait until Monday to see if there's going to be a bank run. We should be able to find out on Saturday if there's going to be a bank run or not, because the banks are open on Saturday. So I started scouring the internet, trying to find any sort of news of any possible bank run that was occurring on Saturday. And sure enough, I found one. In an article titled "Contagion Spreads, Desperate Customers Line Up Outside of First Republic Bank to Take Their Money Out After SVB Bank Collapsed." Photos of long lines at First Republic Bank in Los Angeles started causing fears of more bank collapses. Similar photos showed up at other First Republic banks around the country. Fears started when analysts pointed out the similarities between the estimated value of the assets versus the actual value between First Republic Bank and Silicon Valley Bank. And just like Lehman Brothers in March of 2008, First Republic came out saying that their liquidity remained very strong in a bid to calm the nerves of depositors following Silicon Valley Bank's collapse. First Republic Bank sought to reassure customers after its share price crashed on Friday, but the fear remained that about 68% of the bank's deposits, or about $120 billion worth of deposits, were not insured. So as you can see, through Saturday, everything looked identical to the 2008 financial crisis. The only question we didn't know, which we were pretty sure we were going to get news of on Sunday, was whether or not Silicon Valley Bank would be bailed out, causing more of a Bear Stearns moment where the stock market recovers, or if they were going to be allowed to collapse, which would cause more of a Lehman Brothers type of moment where the stock market tanks and it's down 20% in a month. Well, as we were waiting for news of a Silicon Valley Bank bailout, news came out that regulators had closed New York's Signature Bank. This now marked the second major bank collapse in the last 3 days, and now 2 of the 40 largest banks in the U.S. are out of business. And remember earlier how I said that Silicon Valley Bank, their main problem was that their assets of their mortgage-backed securities and their treasuries had gone down, and if there was a bank run, it would cause significant losses for the bank. And right now, everybody's saying, well, it's a one-off. It's just Silicon Valley Bank. There's nothing to worry about. But we also have news that it happened to Signature Bank as well. So clearly, it's not just a one-off. It's spreading. And I want to read these remarks from the FDIC chairman that he made back on March 6th. He said the current interest rate environment has had dramatic effects on the profitability and risk profile of banks' funding and investment strategies. First, as a result of the higher interest rates, longer-term maturity assets acquired by banks when interest rates were lower are now worth less than their face values. The result is that most banks, and I want you to remember that word, most banks, have some amount of unrealized losses on securities. The total of these unrealized losses, including securities that are available for sale or held to maturity, was about $620 billion at the end of 2022. Unrealized losses on securities have meaningfully reduced the reported equity capital of the banking industry. So the FDIC chairman said that because the Fed raised interest rates so fast, the actual value of bank assets is much lower than it was even 2 years ago. And now banks are in trouble. Is it just Silicon Valley Bank? No. The FDIC chairman said most banks are facing the exact same problem that Silicon Valley Bank faced. Now, even though the Silicon Valley Bank failure was the first failure in 3 years, it's important to understand that it most likely will not be the last. In 2008, from 2008 to 2014, more than 500 banks went out of business due to the financial crisis. It's important to remember it took 5 years for the ramifications of the financial crisis to be fulfilled and hit all of the banks throughout the economy. This is not a one-off. This is not okay. These banks have collapsed and now we're done. This is the start of something much, much greater. And even though the stock market might rise on Monday in relief that these 2 banks that collapsed over the weekend are being bailed out, longer term, over the next 6 months, over the next year, things are likely to get worse. This is one of the reasons that even though the CNN Fear and Greed Index was at neutral a week ago, it hit extreme fear on Friday. Now let's get into the news that came out on Sunday and talk about Silicon Valley Bank's bailout. Sunday morning, the Treasury Secretary Janet Yellen said that the U.S. government would not bail out Silicon Valley Bank. Yellen said that reforms had been put into place in 2008, and that meant they're not going to do what they did in 2008, which was bail out banks again. So FDIC regulators sought to find a buyer for Silicon Valley Bank, and the same way that JP Morgan Chase bought Bear Stearns in 2008, regulators were holding an auction to try to sell Silicon Valley Bank. However, as of the recording of this video, no buyer was found. And in fact, some banks came out and said they chose not to bid because the assets of Silicon Valley Bank were so bad, there was no way that the bank could be saved. So after the FDIC failed to find a buyer for Silicon Valley Bank, a few hours later, the Federal Reserve and the FDIC discussed a backstop to help make Silicon Valley Bank depositors whole and stem contagion fears. Regulators faced an urgent task to stem spread from the Silicon Valley Bank collapse. And they were also on a tight deadline because they had to get this done before U.S. stock futures opened, and they had to get it done especially before the Asian markets opened. If they were unable to do so by that time, we would have seen a massive collapse of the stock market worldwide. Finally, on Sunday, just minutes after U.S. futures opened, regulators unveiled a plan to assure depositors would get their money after the Silicon Valley Bank collapse. In an anxiously awaited announcement from the Federal Reserve, the central bank said it was creating a new bank term funding program aimed at safeguarding institutions impacted by the Silicon Valley Bank failure. At that time, a joint statement by the Treasury, Federal Reserve, and FDIC was announced. This statement is extremely important, so I'm going to read it to you in full. Today, we are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. This step will ensure that the U.S. banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. After receiving a recommendation from the boards of the FDIC and the Federal Reserve and consulting with the President of the United States, Secretary Yellen approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank, Santa Clara, California, in a manner that fully protects all depositors. Depositors will have access to all of their money starting on Monday, March 13th. No losses associated with the resolution of SVB will be borne by the taxpayer. That basically just means that they're going to print money in order to take care of this. We are also announcing a similar systematic risk exception for Signature Bank, New York, which was closed today by its state chartering authority. All depositors of this institution will be made whole. As with the resolution of Silicon Valley Bank, no losses will be borne by the taxpayer. By the way, that term, systematic risk exception, what that is the FDIC is only allowed to insure deposits up to $250,000. However, if there is a systematic risk to the entire banking system, then they can make an exception to that $250,000 limit. And what the FDIC has essentially done is they have made the bank deposit insurance unlimited. So those with even $500 million in deposits are going to get their money back. It's unlimited FDIC insurance. And this sounds a whole lot similar to unlimited quantitative easing, because they're not going to raise taxes to make this happen. What they're going to do is they're going to print money. And we all know what happens when the Fed prints money. Back in 2020, the Fed printed money. And what happened? Inflation. Inflation skyrocketed. So, what did the federal government decide? They decided to bail out the banks, prevent a systematic shutdown of banks all across the country, and in turn, allow inflation to run rampant. Continuing with the statement, shareholders and certain unsecured debt holders will not be protected. Senior management has also been removed. Any losses to the deposit insurance fund to support uninsured depositors will be recovered by a special assessment on banks as required by law. Finally, the Federal Reserve Board on Sunday announced it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all of their depositors. The U.S. banking system remains resilient and on a solid foundation, in large part due to reforms that were made after the financial crisis that ensured better safeguards for the banking industry. Those reforms, combined with today's actions, demonstrate our commitment to take the necessary steps to ensure that depositors' savings remain safe. In other words, 100% identical to what happened to Bear Stearns in March of 2008. The Fed gave banks additional money in order to help them survive in 2008 in March, and now in 2023 in March, the Federal Reserve is giving banks additional money to help them survive. In addition, they completely bailed out Bear Stearns, just like they've now completely bailed out Silicon Valley Bank and Signature Bank. And in addition, they did not bail out bondholders or shareholders of either Bear Stearns or Silicon Valley Bank or Signature Bank. So those stocks would be expected to go to near zero once the market opens on Monday. So then the question was, what is going to happen on Monday? As the futures were waiting to open, everybody wanted to know what the stock market was going to do. And because Silicon Valley Bank and Signature Bank were both rescued and bailed out by the federal government, stock futures opened higher, and not just a little bit higher. They were up over 1%. So it now looks like there's going to be a massive rally on Monday as everybody breathes a sigh of relief and says, oh, it was a one-off, no big deal, everything's fine, let's get back to normal. But of course, if you look at the FDIC chairman's statement, everything is not normal, everything is not okay, and every single bank, well, at least according to the statement, most banks are suffering the same problems that Silicon Valley Bank suffered. Now, also remember how back in 2008, Treasury yields tanked as money got pulled out of the stock market and dumped into the bond market in order to find a safe haven as an asset. And on Friday, the exact same thing happened. In fact, the 2-year Treasury yield posted its biggest 2-day drop since 2008 as the financial crisis raged on. So again, even in Treasuries, the exact same thing that happened in 2008 happened again on Friday. And just like that, the market pricing is swung back to a 1/4 point Fed rate hike at their March meeting next week. On Wednesday, CME futures were pointing to an 80% chance of a 50 basis point rate hike. By Friday, that had dropped down to a 39% chance. So what's happening? Why would the Federal Reserve only do a 25 basis point rate hike if inflation is skyrocketing? Well, remember, it was those massive interest rate hikes that have caused all of this banking crisis to occur in the first place. So something is now broken, and the Federal Reserve might have to stop raising interest rates in order to fix the bank situation. On the other hand, if they do, this is going to cause inflation to start going up again. So at this point, the Federal Reserve has lost control of the economy. If they continue to raise interest rates, it's going to put banks in a worse situation. If they stop raising interest rates or lower interest rates, then inflation goes out of control. So either way, the economy is screwed. At this point, the Federal Reserve has lost complete and total control, and they're just trying to delay any sort of massive collapse of the economy that at this point is now pretty much certain. Now, as all of this news around the banks is going on, it can be easy to forget that we have some major market-moving news coming out this week. On Tuesday at 8:30 a.m., or about an hour before the markets open, we get the CPI, or Consumer Price Index. That is expected to have come down pretty significantly over last month, with CPI dropping 0.3% year over year compared to last month, and the core CPI dropping 0.1% year over year compared to last month. However, the monthly increase is expected to be identical to where it was last month. Then on Wednesday, we get retail sales, but we also get PPI, which is the Producer Price Index. And that is expected to have come down significantly over last month. If, however, it comes in higher than expected, that could cause another major drop in the markets on Wednesday. Then on Thursday, we get some housing data, and then on Friday, we get the consumer sentiment. And while inflation is expected to go down, there are some parts of the U.S. economy pointing to inflation actually increasing once again, as 31% of new cars are sold above their sticker price last month. Now, if you're afraid of what's going to happen to your bank stocks, such as Ally Bank or SoFi or anything like that, just remember that most banks have the exact same problem that Silicon Valley Bank had. However, it's not a problem so long as the bank is allowed to operate as normal. It doesn't become a problem until the bank is forced to sell off those assets, and that won't happen unless there's a bank run. If there is a bank run on any bank of any stock that you're holding, that could cause the bank to collapse. So that's what you have to watch out for. Right now, the banks technically should be okay so long as there's not a bank run or a massive amount of deposits coming out of the bank. Now, as we have a lot of breaking news, don't forget to sign up for the newsletter, which goes out every Monday morning, which explains everything that you need to know before the market opens on Monday to get you completely and totally prepared for the week ahead. You can sign up for that newsletter. It's a free newsletter at stockcurry.vip/newsletter. That's stockcurry.vip/newsletter. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on as well. And make sure you hit the like button and subscribe so that you can get notified when my next video comes out. And if you missed the last video that I put up on Thursday, where I talked a little bit about what's going on in the stock market and a few other stocks outside of the banking sector, make sure you go watch the last video that I uploaded here.